What's up, guys? This is Manoj Shaptani. I welcome you all on behalf of the Edupedia world. It's been a wonderful day outside. I'm sure that you guys must be enjoying your life to the fullest, guys. Wonderful that is. I just want you to keep that enthusiasm intact for entire life of yours. Guys, by now we have already covered 11 video presentations wherein we have discussed so many things about so many topics relating to foreign exchange. Uh, 9 of my presentations were solely dedicated towards the concepts that you need to understand in order to grasp the complete nuances of the core topic relating to foreign exchange, and 2 were solely dedicated to the kind of questions that have already been asked in CE final examinations in the previous attempts. This is going to be the last video presentation in which I'm going to discuss with you the remaining questions which have already been asked in CE final examinations in the previous attempts. So this is going to be the last video presentation for the topic of foreign exchange. Post this presentation, I'm going to mark the beginning of another fascinating and a most interesting kind of topic, which is just a step ahead towards this particular topic of foreign exchange, and that is derivatives. So from next video onwards, you'll get to learn about what are all different kind of things that you need to acquire, what all different knowledge that you need to acquire in order to understand the topic of derivatives. That I'll be discussing in my forthcoming presentation. So let's mark the beginning of this particular one with the first question of the day, and that will be this. This question was asked in CE final examination for November 2008, and it says it is given that dollar 6 month T-bill. T-bill basically means treasury bills. That is one that are those are the ones which are basically being issued by the government of a nation. So the dollar 6 month T-bills interest rate on that particular dollar 6 month treasury bill is 7%. Risk free 6 month Japanese bonds will provide you an interest of 5.5%. The spot exchange rate has been provided to us as 1 yen equals to dollar 0.009. What is going to be the 6 month forward exchange rate? So guys, before heading towards the solution part, let's understand this question first of all. Though I have precisely provided you the solution here itself in the question, but still, let's understand first of all the question. Guys, by just looking at the question, you can simply understand one thing, that the dollar interest rate is 7% as compared to the one from Japanese, which is 5.5. So which one is the more which is that particular currency in which you can earn more amount of interest? Absolutely, dollar. Okay. But having said that, why dollar is paying you 7% and why Japanese bonds are paying you merely 5.5% is solely depending on the kind of inflation of their country. That simply means that the US economy is going through a higher rate of inflation as compared to the Japanese economy. The sole reason why Japanese are providing you less amount of interest is because of the inflation. Amongst many other factors, inflation rate can be one of the major ones. Now, you need to understand one thing, guys. Always remember one thing, that the currency which is having the higher amount of inflation is usually the one which goes on to discount. Obviously, if there is more inflation in a particular currency in a particular country, okay, in that particular front, that simply means that the currency of that particular country is going to be going in the decreasing trend somehow, and that's why it's being told that the currency of the country which is having higher amount of inflation usually goes ahead with the discount and not on the premium side. So by looking just on these two simple things, that the dollar is providing you an interest of 7% and Japanese bonds are providing you an interest of 5.5%, what you can simply derive from this particular thing, you can simply go ahead with this thing, that the Japanese currency will definitely be going premium as compared to the dollar one, because here the inflation is quite low as compared to what is being available in US economy. Simple, guys, clear front, concept clear, superb. Now coming to the second part, which is the spot exchange rate is 1 yen equals to dollar 0.009. What do we simply understand by this quote? This quote is a direct quote for which country, which currency? This quote is a direct quote for dollar. Why? Because dollar is being provided to you in right hand side. So one yen is equal to n number of dollars. So for that particular thing, we can simply assess that this quote is provided to you as a direct quote for dollar and an indirect quote for yen. So since the quote which has been provided to you is a direct quote for dollar, I can simply presume and go ahead with the fact that the home currency for this particular question is gonna be dollar. Direct quote means dollar, means home currency in that particular case. Now, all my things that I need to deliver to you as far as the question is concerned has already been provided to you. Now let's go ahead with the solution part. Now guys, since the rate of return which is available on home currency, we have just evaluated which is the home currency, that is dollar. So the rate of return for home currency is gonna be 7% that I have mentioned. RH is equal to 7%. And what's gonna be the foreign currency for us in this particular question? It's gonna be Japanese bonds. Whatever the kind of interest that I'm earning from Japanese bonds is the one which will be classified as the return from foreign currency, which is none other than 5.5%. The next thing is 1 yen is equal to dollar 0.009. We need to evaluate the forward exchange rate. Now the simple formula and the simple concept for this particular stuff is that the forward exchange rate divided by what's going to be the current spot exchange rate in the market. Okay, that has to be taken care of in the left hand side. That will be equal to 1 plus the kind of return that you'll be earning on your home currency. 1 plus RH divided by 1 plus RF, that is the rate of return that you'll be earning from your foreign currency investments. That is a simple formula, simple concept. Now, it may be a possibility that you guys may not go ahead with the ratification of formula. Thereby, I made you understand this particular concept, which is the inflation one. Okay, the only idea behind telling you this particular thing, that which currency is going to be going at premium and which currency is going to be going at discount, is solely dependent on the kind of interest or inflation rate they are providing you in the question. So without looking in the solution part, let's analyze one thing, guys. Here in this particular question, it has been told to us that dollar is providing you a higher rate of interest. That simply means here the inflation is more. And Japanese bonds are providing you less amount of interest. So here the inflation is low. Since the inflation is low, now in this particular question, the spot exchange rate here is 1 yen equal to 0.009. So what will be the forward exchange rate for this particular question? It's gonna be something which will provide you 1 yen equal to dollar 0.09 plus something and not minus, because here in this particular case, Japanese bonds, the Japanese currency is gonna be going at premium. So what do we simply understand when this case is, here if I tell you that in one particular yen I am able to acquire just $0.009. Now from now on, after a period of 6 months, I will be able to earn something beyond that. I mean something beyond $0.009. Why? Because the Japanese currency will be going at premium. So I can purchase more of the dollars with 1 yen as compared to what I can earn as of now on my spot exchange rate. Simple, guys. So there I can simply go ahead with this concept, which is forward exchange rate divided by spot rate equals to 1 plus RH divided by 1 plus RF. So what will be my forward exchange rate? That will be simply 0.009 multiplied by 1.35 1.035 divided by 1.0275. So with that, I can simply go ahead and reach to a conclusion, which is that the forward exchange rate for a 6-month period will be dollar 0.00907, which is obviously greater than 0.009. Simple, guys. Cool. I will just like to conclude one particular thing with this question. Okay, even if you don't remember the formula in your examination, just don't go for the formula at all. Okay, just remember the concept. If in case you are directly hard and strong enough to remember and retain the concept in your mind, I'm sure about one particular thing, that even if you don't remember the formula, still you'll be able to write it in your own presentation. Though you are clueless about the formula, but still you'll be able to present your answer if in case you are having a good idea about the concept of that question. So always and always go and try to retain and understand the concept, and then only you'll be able to solve your question even if you don't remember the formula at the end of the day. Clear, guys? Shall we proceed further? Let's go ahead with the second question. This question was asked in CA final examination and it says that the shoe company sells to a wholesaler in Germany. The purchase price of the shipment is 50,000 Deutsche Marks with the term of 90 days. Upon payment, the shoe company will convert the Deutsche Mark to dollars. The present spot rate for Deutsche Mark per dollar is 1.71, whereas the 90 days forward rate is 1.70. We are supposed to calculate and explain number one, if the shoe company were to hedge its foreign exchange risk, what would it do and what necessary transactions it has to comply with. That is number one thing. Number two, is the Deutsche Mark at forward premium or at a discount? Number three, what is going to be the implied differential in the interest rates between the two countries? We need to use interest rate parity assumption. Now, this is the question which was asked in CE final examination. Now let's understand the question here itself before heading towards the solution. Guys, there is a shoe company who sells to a particular wholesaler in Germany. Germany is like, as of now, Germany is a country which is having a normal currency which is being shared by other countries as well of Europe, that is Euro. But earlier they used to have Deutsche Mark, that was their own currency. So even in today's textbooks, still this particular currency is available, which is Deutsche Mark. So now the purchase price of that particular shipment that they have sent, it is involving an amount of 50,000 Deutsche Marks with a term of 90 days. So I have provided you the order. After a period of 90 days, the person is going to pay me 50,000 Deutsche Marks. Now, upon the payment, the shoe company will convert the Deutsche Mark to dollars. That is what they are going to be doing because they must have been based out in US. Now the present spot rate is Deutsche Mark per dollar equals to 1.71. Okay, so I can simply say with $1 you can purchase 1.71 Deutsche Marks, whereas the 90 days forward is from that $1 you will be able to purchase only 1.70 Deutsche Mark. Okay, simple guys. Now number one thing, I will be able to tell you the second part before making you understand the first one. You tell me which is that one currency which is going to be at premium and the other currency which is going to be at discount. Think about it. Simple. Earlier, like today, I can buy from $1 1.71 Deutsche Marks. After a period of 90 days, I can buy only 1.70 Deutsche Marks out of that $1. So which is that currency which has grown stronger? Which is the one which is going at premium? Obviously, it's Deutsche Marks. Earlier, you have to spend 1.71 Deutsche Marks in order to attain $1. Now you just need to spend 1.70 and not that 0.01 Deutsche Mark in order to attain $1. So Deutsche Mark is the currency which is going to be at forward premium and dollar is the one which is going to be at forward discount. Now coming to the first part, which is if the shoe company were to hedge its foreign exchange risk, what would it do? Simple guys, you don't know that whether after a period of certain days there could be a possibility that the foreign exchange might end up making you might end up in such a situation that it may land you up in losses. Okay, so it's always good and prudent to go ahead with the forward. Okay, you need to secure your position in the forward market. And what would you do? You'll simply resort to a situation wherein you'll pay in that particular case 1.70 at a rate of 1.70. Okay, so what transactions are necessary? Simple, go ahead with the forward rate and don't just leave your transaction only on the basis of spot rate. Hedge your position on the forward rate. That is what is being required in this particular question. Lastly, it says what is the implied differential in interest rates between the two countries. So simple, it's going to be again a very simple exercise, which is the interest rate parity assumption with the help of it. So the forward rate is 1.71. Out of the same, you'll deduct the spot rate, which is 1.70. You'll divide the same with the spot rate, which is 1.70. Multiply it with 360, taking it as a number of years for a day. Though 365 are the number of days, but in finance, most of the assumptions help you up with a static rate, which is 360 days basically. Divide the same by 90 days because in your case 90 is the applicable number of days, and multiply the same with 100% and you'll get your implied differential in your interest rates. So that's how this question is likely to be presented in your examination sheets. Are we guys clear with this particular question? Shall we proceed ahead with the solution part? Let's go and understand the same. So in order to hedge your risk, the shoe company would take your forward cover by selling Deutsche Marks for 90 days forward at Deutsche Mark 1.70 per dollar. It will get dollars 29,412. Simple. That is number one thing. And since I have mentioned you up, guys, that in this particular question, by the quotes, by just looking at the quotes, we got to know that dollar quotes are at discount. Okay, so we can simply say that dollar quotes are lower in the forward market than in the spot market. Then dollar quotes are at discount and Deutsche Marks are at premium. Lastly, what should be the interest differential? That is the same thing which I mentioned you up. Forward exchange rate, which is Deutsche Mark per dollar, which is 1.71 minus spot Deutsche Mark per dollar rate, which is 1.70. Divide the same with the spot rate, which is 1.70. Multiply it with 365 because here it's mistakenly I told you one thing, which is the assumption. So the holding period assumption is the one which asks you to go ahead with 360. Here it's the interest rate parity assumption. So go ahead with the 365 normal days of a year. Divide the same with 90, multiply the same with 100, or you can directly go ahead without multiplying the same with 100 if in case you are not presenting your question in your percentage form. So you'll get to know that the rate of return which is available on Deutsche Marks minus the rate of return on your dollars, that will be providing you an interest rate differential of minus 0.0237, or I can simply say 2.37 negative percent. So the negative sign basically indicates that the dollar is at discount to Deutsche Mark, and if the interest rate parity theory holds, then the interest rate in US should be 2.37% higher than in Germany. Simple, guys. If you are having larger interest rates in your country, definitely your currency is gonna be ending up at a situation of discount. So that is the same thing which is being told in this question as well. So are we guys clear with this one? Cool, perfect, guys. Just keep yourself intact with this kind of enthusiasm, and we're about to complete your entire chapter within a few minutes. Let's go ahead with the next question. This question was asked in CA final examination for November 2010, and it says that consider the following. The spot rate is equivalent to $0.75 per Deutsche Mark. Forward rate 1 year is $0.77 per Deutsche Mark. Interest rate on Deutsche Mark investment will land you up at a interest of 7% per year as compared to the one which is in dollar for 9% per year. Suppose that the transaction costs in the foreign exchange market equals 0.25 per transaction. So do covered arbitrage profits exist in the above situation or not? So guys, we are supposed to tell in which currency do we need to invest and which currency do we need to take up the forward foreign exchange rate benefit, differential benefit. So which one to go ahead and which one to not. Always remember, guys, again, the concept which makes you understand this thing, which I just made you understand in my last questions as well. Here, you can simply say that since the interest rate for Deutsche Mark is 7% and the interest rate for dollar is 9%, which currency is going to be the one which is going to be forward at a forward premium? Think about it and decide yourself. Okay, take just a 5-second time. Okay, which currency will end up at a forward premium? Think, think, think. Time's up, guys. So simple. Have you decided which one? Since the Deutsche Mark interest rate is 7%, which is less than the one which is being provided to you in dollar, I can simply say that Deutsche Mark is gonna be the one which is going to be at forward premium, because here the interest rate is less as compared to dollar. Simple, guys, and this is the same thing which is being reflected in our above statement as well. Spot rate is 1 Deutsche Mark equals to $0.75, but the forward is 1 Deutsche Mark will help you fetch more dollars, which is $0.77. So which is the currency which is at forward premium? Obviously Deutsche Mark. Now this thing is clear, guys. Cool. Now our second problem, in order to understand and go ahead with this question, is which currency to borrow the money from and which currency to invest the money in. Okay. Now here we have got two choices. One, we can borrow the money in Deutsche Mark and invest in dollars at 9%. Or secondly, we can basically borrow the money from dollars and invest the same in Deutsche Mark. So how do we go about the same? Always and always remember, guys, we need to here take care of a differential basis. Okay, we need to understand that what benefit do we get on the basis of forward exchange rate differential, and what benefit do we get on the basis of interest rate differential. Both the things have to be considered in order to evaluate which way to go forward. Number one thing, that is something which is most important for you guys to attain and learn. Do we get the best benefit of foreign exchange differential, or do we get the best benefit of interest rate differential? That is what we need to understand, and with the help of it we can simply go ahead with the question. Are we guys excited to learn that particular thing? Let's go ahead with this one. So first thing is attain that forward rate premium. Okay, how do we go about the same? Simple. Your forward exchange rate is 0.77. Deduct 0.75, which is the spot rate, out of the same. Divide the same with the spot rate, which is 0.75. Multiply it with the number of months maximum, which is 12. And what is going to be the what all months do we be including in your case? That is also 12 in this particular case, because it has been told to us we need to evaluate the question on annual basis. So it is going to be 12 again. Multiply the same with 100%. You'll get to know that the forward rate premium is 2.67. Okay. Now, guys, you're getting a benefit of investing in dollars for just 2%, but at the same time, you are losing onto forward exchange rate premium by 2.67%. Which way you will go ahead? Just think about it. You're basically getting a benefit of 2% more by investing in US dollars. So which one is a better option? Do we invest and get the benefit of just 2 more percent by investing in dollars, or is it beneficial for us to invest in Deutsche Mark and attain the benefit of forward exchange rate differential, which is gonna be 2.67%? Obviously, we need to go ahead with the investment in Deutsche Marks, and that is what is being recommended in this particular question. So now the process is gonna be very simple. You need to borrow in dollars, convert the same into Deutsche Mark, and invest it in Deutsche Mark, because here you will get more benefit on financial like foreign exchange rate differential basis. So I provided you an assumption as well in order to make you understand this particular thing more clearly. Assume that you need to borrow 1 million dollars, okay, and the repayment would be at a rate of 9%. That is something which has been provided to us in the question itself for 12 months. So $1 million multiplied by 1.09, you'll get to you are supposed to pay back after a period of a year $1,090,000. Now all you need to do is you just need to convert that borrowing of $1 million into Deutsche Mark at the spot rate, which would yield you Deutsche Mark 3,33,333 Deutsche Marks in your pocket. Invest this particular amount for 12 months, and you will be able to yield a Deutsche Mark interest on totality basis, including your interest. The amount will be 1,04,26,667. Now convert this particular money back into dollar at $0.77 per Deutsche Mark, which would give you one particular million 1,098,533. So what's going to be your net arbitrage in this particular case? You're supposed to pay back 1,090,000 back to the bank, and you're able to attain a profit of 8,533 after deducting 1,090,000 from your pocket. After the same, you are supposed to provide your commission as well. That is 0.25% on your 1 lakh, and 0.25%, because you are again going ahead with the repayment basis, you have to pay that 0.25% commission on 1,098,533 as well. Still, you are able to make a net arbitrage profit of $3,287. So, which is a better way? Always and always invest on the behalf of, after evaluating both the possibilities, guys. Number one, forward rate differential and interest rate differential. the one which makes you end up earning some good amount of profits, always and always go ahead with the same. This was the question which was asked in CA final examination for November 2010. I hope you guys are pretty much clear with it, guys. Bang on. Let's go ahead with the last question of the day, and that will be the one which was asked in November 2008 and May 2010. This question was asked in CA final examination. The rate of inflation in USA is likely to be 3% per annum, and in India it is likely to be 6.5%. Again, apply the very same concept, which is the one which is providing you the better returns as far as the forward premium is concerned. Which currency is going to be going at forward premium? Obviously, the one which is providing you less amount of inflation rate. So here the inflation rate in USA is far less as compared to the one which is being there in India. So the US dollars will be going on to the forward premium. Now the current spot rate of US dollar in India is 43.40. Find the expected rate of US dollars in India after a year and 3 years from now using the purchasing power parity theory, triple P theory. So solution, after a year, 43.40, again apply the very same concept, guys. Multiply the same with the one which is providing you the home currency rate, which is 1.06. Divide the same with the one of foreign currency, which is 1.03. You'll get $1 will be equal to 44.8751. This is something which will be happening in case of application of 1 year, post 1 year. Okay, simple. 43.4 is the today's spot rate, and since we know that the US dollar will be going at forward premium because the inflation here is less than what is being offered in India, so this 43 will obviously increase and not decrease. So 43.40 multiplied by 1.06 divided by 1.03. You'll get a figure of 44.8751 after a year. Now, if in case the same thing is applied after a period of 3 years, simple guys, 1.03 multiply by 1.03 and multiply by 1.03. That is something which will happen in case of US dollars. That will be 1.098 after a period of 3 years. In case of India, 43.40 will be multiplied thrice, one after the other, by 1.065, multiplied by again 1.065 for the second year and multiplied by 1.065 for the third year. You will get a figure of 52.425 with respect to the total amount of Indian rupees after a period of 3 years. Divide the same with 1.098, that is the dollar rate. You'll get a per dollar rate of 47.9763 Indian national rupees. That is what will happen in case of after the applicability of 3 years. I hope you guys are pretty much clear with whatever the kind of stuff that I made you understand in this particular complete presentation. And are you guys bang on with the kind of concept that we have already made you understand with this complete chapter? Yes, then just go ahead and revise and retain whatever the kind of stuff that I have told you and made you understand with this particular presentation. You're supposed to make us proud, guys. Don't forget that. Okay. So with this, I'll sign off my chapter, which is forward foreign exchange. I hope you guys got the complete clarity with this particular chapter and this particular presentation as well. If in case you've got any kind of query or grievances from and you need to discuss the same with me, definitely do write to us on our Edupedia pages and our YouTube channel. We'll get back to you on the same kind of stuff. With this, I'll say thank you on behalf of the Edupedia. Well, stay connected. That will help us in understanding your needs way better, guys. And keep interacting. Your motivation, your kind of stuff, and the kind of query that you share with us, they always keep us on our toes in order to provide you better services. And that's how we all do it. So if in case you have liked our video, if in case you have found this video informative, do share it with as many people as you can, guys, because sharing is caring, and that is what we are here for. Like, share, and subscribe to our channel, and I'll see you in my next presentation with a whole new chapter altogether. Till then, sayonara, God bless you all, goodbye.